Y para hablarnos sobre la relación entre el crecimiento económico y el desarrollo del mercado de capitales, invitamos a la doctora Annette Kyobe del Fondo Monetario Internacional, economista de la División de Mercados Emergentes y Estrategia en el Departamento de Evaluación y Políticas del Fondo Monetario Internacional. Su trabajo está enfocado en las relaciones entre países, incluyendo crecimiento, desarrollo económico, vulnerabilidades, balanza de pagos y los tipos de cambio. Anteriormente trabajó en Polonia en el Departamento Europeo y en el Líbano y Jordania en el Departamento del Medio Oriente. Bienvenida.
Good morning. My name is Annette Kyobe, and I will be presenting a paper on financial deepening, capital markets, and growth. And in the second part, I'll look to see whether or not there's a role for government in developing capital markets. But before I begin, I would like to thank the conference organizers for inviting me to see their beautiful country for at least a couple of days. I also would like to thank the translators who will be helping me with my presentation, because unfortunately I don't have the good fortune to speak Spanish. So very briefly, I will outline what my presentation will do. So the first thing I will do is present why developing capital markets could be important. Second, I will present some stylized facts on how developed financial and capital markets are in Latin America, including Colombia. Third, I will look at the impact of financial development on growth and stability. And in this section, I will also seek to address the question of whether bank or capital market development becomes more important as countries grow. And lastly, I will also look at the role governments play I will also look at the role that governments can play in facilitating capital market development. So as economies grow, the size of capital markets increase relative to banks. So this chart presents capital market development as measured by private and public bond markets and stock markets, also pension and mutual funds, relative to bank deposits. So the brown shaded area basically shows that as countries develop, log GDP per capita increases, the size of capital markets is actually much larger than that of banks, so the ratio is larger than 1. So why develop capital markets? Essentially, there are two reasons why capital markets are important to an economy. The first is financing for growth, and the second is enhancing financial stability. Corporate bond markets are particularly important for financing large investment projects, which for the most part are quite risky and take time to materialize, and banks quite often are not willing to finance such projects. So because corporate bonds are also traded, unlike loans, this allows investors to share and shed risk. Local government bond markets are important for governments to finance their deficits without resorting to financial repression, something I'm sure you're very familiar with given the region. And if governments can borrow in local currency, this also reduces their exchange rate risks and leaves them less vulnerable to sudden stops in capital inflows. And lastly, improved access to finance, including foreign capital, lowers the cost of capital in an economy and relieves credit constraints to both households and small and medium-term enterprises. On enhancing financial stability, there are basically two aspects with which capital market development helps. So first, the development of derivative markets allow for organizations and financial institutions to diversify risks. Secondly, a more diversified financial system that includes capital markets also allows for a more stable and better able system to absorb shocks. So for instance, in this current environment where banks are deleveraging, and in a number of countries they're faced with high NPLs, the capital market is the alternative form of financing in such an economy. So I've provided some rationale for why developing local capital markets could be important. This next section is basically going to look at some stylized facts on financial development in Latin America. But to tell the story, we need to go beyond individual measures of financial development. So what we did is we created a financial development index. This index comprises two sub-indices. The first is financial institutions, and within financial institutions, we capture here both banks and pension funds. The second arm of this index is basically financial market development, and here we talk about public and private bond markets as well as stock markets. Within these indices, we also capture various aspects of financial development, such as depth, access, and efficiency. And for the remainder of the presentation, I'm really going to focus on the purple part, which is basically financial markets. So why do we create an index of financial development as opposed to just looking at individual measures? So the reason is that a lot of individual measures of financial development are insufficient to capture what we mean when we talk about the development of, be it banks or capital markets. So the left-hand side chart shows financial depth for the United States. And if we were to measure financial depth by a traditional measure, such as bank credit to the private sector, you'll see that this was broadly flat from 1980 through to 2012. And it completely misses the financial excesses of the 2000s. But if we look at a broader measure that captures total assets of banks and non-banks, we'll see from 1980 to 2012 that this has increased twofold, from about 200% of GDP to 500% of GDP. As another example, financial access is not to be confounded with financial depth. So this chart basically plots, again, the same variable, bank credit to the private sector, against financial access. And here financial access is given as the percent of adults with access to an account. So for the same level of bank credit to the private sector, about 100%, Vietnam and Korea have vastly different levels of financial access. So in Vietnam, for instance, only 25% of adults have access to accounts, whereas in Korea, it's 100%. So Latin America, where does it place on financial development? And here again, I'm talking about a more broad index of financial development that captures both financial institutions, financial markets, and also aspects within that, such as depth, efficiency, and access. So here the index is normalized between 0 and 1, with 0 being obviously the lowest level, and this is denoted by red, and green is the highest level of financial development. And if we look at Latin America, we see spots of red, so basically Central America with countries like Bolivia and Paraguay performing quite poorly, the Caribbean as well, Argentina. Colombia fares significantly better. So here I will present individual country data of financial development for a group of countries divided into advanced, emerging, and low income. And as can be expected, the advanced countries perform very well on financial development, with countries like Switzerland, Japan, and the United States leading the pack. Colombia lags a large number of emerging markets on financial development, with countries like China, Brazil, South Africa, India, Chile, and Poland doing much better than Colombia on financial development. Looking closer at financial market development, so this is a much narrower aspect of financial development. This was the purple portion that I showed earlier. Colombia is 4th on financial market development, following Brazil, Mexico, and Chile. Looking at how Colombia has performed across time on financial market development, again, the concepts that we look at are access, depth, and efficiency. We see that financial market indices have improved considerably. The blue bar is where Colombia was in 2002. The red bar is where Colombia was in 2013. And again, by access, remember this is an index, so this captures various components of access in financial markets. So for example, access here is the percent of market capitalization outside of the top 10 largest companies. It also includes the total number of issuers of debt, domestic debt, external debt, the debt of non-financial corporations, and also the debt of financial corporations. By depth, we mean stock market capitalization and also stocks traded, and other debt securities such as government debt, and again, the total debt securities of non-financial corporations and financial corporations. And here, by efficiency, what we capture is basically stock market turnover. So if you look at efficiency, which is basically the last set of bars, you see that efficiency has increased threefold in Colombia from 2002 to 2013. If we look at a time series of what has actually been driving this improvement in financial development in Colombia, we see that it's mostly been driven by equity market capitalization. This is basically the red line chart. So if we look to see how that has increased, we basically see from 2001, it's gone from 10% of GDP to more than 60% in 2011. But the thing to note is that it's actually stalled. So as of 2011, it's basically plateaued. We don't have the data for a group of countries to look to see what's happened since then. You probably know this better than I do. If you look at something like credit to the private sector, this has remained broadly flat. Benchmarking Colombia again to the region and to a number of Asian emerging markets and also a few G7 countries, you see that Colombia lags again with domestic stock market capitalization at about 60% of GDP compared to a country like Chile where it's 120% of GDP. So now with these stylized facts at the back of our mind, I'm going to talk about the empirical relationship between financial development and growth. So this chart basically is a summary of a lot of analytical work that we have done to establish this relationship. So I won't go into the technicalities of it, I'll just describe our results. So basically what we have here is financial development on the horizontal axis. On the vertical axis, we show the contribution to growth from financial development. And the thing to note is an obvious nonlinearity in the relationship between financial development and growth as financial development increases. And the second thing to note is Colombia basically is before the turning point. So the part of the curve from Gambia to Poland basically illustrates that if you increase financial development, you should see growth returns. After this point, after Poland, you get diminishing returns to growth. And as financial development becomes very, very high, the level of Japan, you actually get negative impact of growth on financial development. Thank you. This relationship is also to be taken with some caution, because if you plot the 95% confidence interval of financial development, the turning point is somewhere between 0.5 and 0.7 of the index. It's not one number, at least we're not able to identify that. I had earlier made the assertion that finance has some kind of negative effect on growth after a certain point. So what we do here is we try to disentangle where this effect could be coming from. So again, this basically plots the financial development index, but what we do here is we disaggregate where growth could be coming from. So the yellow part is total factor productivity growth. The blue line is the rate of capital accumulation. So what you see is this non-linearity is present only for total factor productivity growth. So basically what this result suggests is that the too much finance result results in a misallocation of capital. It doesn't result necessarily in less capital accumulation. Here I will talk about the impact of financial development on volatility. Earlier I had made the assertion that financial development increases stability, and I gave various reasons why this could be the case. So we looked to see whether or not we can actually see this relationship empirically, and in fact we can. Again, the part of the curve from Gambia to Poland basically shows that if you increase financial development, you see a reduction in volatility of growth. Past that point, you get an increase in volatility. Most Latin American countries would benefit from more finance because they're located on the part of the curve that's before the turning point. So countries like the Dominican Republic, Paraguay, Honduras, Costa Rica, El Salvador, Panama, Mexico, Colombia, and Peru would all benefit from financial development, which would hopefully increase growth and reduce instability. But how much more finance is needed? And what type of finance is needed? Is it bank finance or is it capital market finance? So what this chart shows is financial development gaps of a country relative to its own fundamentals. So what we do here is we look at actual levels of financial development in a group of Latin American countries, and we benchmark these relative to their fundamentals. So their benchmark level of financial development as given by income per capita, population, old age dependency ratios, and also governance indicators. So the idea is, if you're a poorer country, perhaps you don't need that much finance. Similarly, if you're corrupt, you wouldn't expect financial development to take off. So what you see is that a number of countries from Panama through to El Salvador actually perform really well on financial development. But note, this is relative to their own fundamentals, and albeit fundamentals could be low for certain countries. And now, where does Colombia place on this measure? And Colombia basically is the country right after Nicaragua on this chart, so a little bit to the right of the middle of the chart. And what we see here is that financial development in Colombia is underdeveloped relative to fundamentals. And primarily, this is driven by underdeveloped capital markets. However, institutions, and here we talk about bank developments, are actually overdeveloped relative to fundamentals. And I think this result derives from regional expansion of your large conglomerates, one of which is on the board. I think Grupo Aval is a very big one. So I have provided some intuition for why a various type of development might be more important. So for example, in Colombia, it seems capital market development is lower relative to fundamentals. But is there another way that we can establish this relationship? And the answer is yes. So this chart basically shows, as incomes rise, this is the left-hand side chart, the marginal benefit from banking development actually falls. So if you look at quantiles after the 50th percent, you basically see a downward sloping line. And so this illustrates, as income rises, the marginal benefits from financial institutions decrease. You get a flip side of that same story when you look at what happens to the growth benefits of stock market capitalization, here captured by financial market depth. And here again, around the same turning point, you see that after countries pass a 50th percentile of log GDP per capita, increased stock market capitalization, denoted by this yellow line, increases and results basically in more benefits to growth. So what are the preconditions for capital market development? And the first is, I'm sure, something you're not surprised by: sound macroeconomic policies to attract investors. In addition, governments have the role of basically ensuring that a credible and continuous source of fixed income securities is available for the market to absorb. Secondly, strong institution and legal settings are important to protect investors, as is a well-functioning financial infrastructure. This I think you can speak more to than I can. Lastly, markets must be a minimum size due to fixed costs. Not every country can have a large local currency market simply because there's no need for it, and also because the cost of setting up a local capital market can be quite prohibitive. So quite often, if a country is small, perhaps the better option is to tap into regional capital markets as opposed to establishing your own. What is the role for governments in ensuring capital markets develop? So the first is they need to meet the preconditions for capital market development. These were the first four that I introduced. But it's also important for a government to have some active policies to increase the size of capital markets. So the first thing a government might want to consider is financial liberalization. This would diversify the investor base. Again, keeping in mind that foreign capital can be quite dangerous, there should be some impetus to basically manage the potential increase in volatility due to increased capital flows. A second way to increase the size of capital markets is pension reform. So think of a country like Chile. So here you create institutional investors to provide impetus for local government markets. As you well know, pension funds need to invest in longer-dated securities for asset liability management purposes. And also, having institutional investors in the market results in positive externalities in the sense of increased financial innovation and efficient functioning of markets. The third role the government can play in improving local capital markets are tax and corporate governance reforms. So tax reforms to make tax treatment of securities issuance more attractive would be important. Simply, in addition, corporate government reforms to protect the interest of minority investors would also be important. All of these factors basically serve to increase the supply and demand of securities in a country. And with this, I end my presentation. I'm open to questions if you have any. I was hoping this could be a somewhat interactive session.
Sorry, I can't remember the slide, but I had a question.
Could you describe it?
It'll be easier with the slide.
Okay.
No, okay.
Stop. Federico, you might have to hold
No, let's
the keys.
maybe. In terms of when you speak about access, you speak about in terms of the investors, in terms of the opportunity the small investor has, or the development of complex investment instruments for all investors.
Right now, when we think about access, we think about the availability of finance to smaller investors so that it's not going to, for example, a concentrated base of large investors. So by access, we really are talking about the type of investor as opposed to the plethora of products that you might have. But that's not to say it's not a good idea to look at access beyond just the type of investor. But keep in mind, we did this work for 128 countries, and not all countries have sufficient data in order for us to create an index that looks at the variety of investment products.
On your experience, you mentioned that probably the capital market, the Colombian capital market, was underdeveloped, while the banking market seems overdeveloped according to fundamentals. On your opinion, or what could be a hypothesis of this trend that you are diagnosing on Colombian market?
I think in Colombia, and again, perhaps somebody might want to speak about this in more detail. The issue is we're basically capturing the regional expansion of your large conglomerates. So banks like Grupo Aval that basically don't only have assets in Colombia, but also regionally. So when you look at financial development, it looks much larger than what you would expect for a country like Colombia. Thank you.
Dr. Kyobe, thank you very much for your presentation.